All right, welcome everyone to the deep dive. We know you're busy people who want to quickly but thoroughly understand really complex topics. And that's why we're here, really, to give you that shortcut. So today we're going to dive deep into Bitcoin. We've got a fascinating presentation to unpack here. It's called Bitcoin, the Digital Gold Rush, given by Michael Saylor last October.
Yep, October 2024.
Right. And we're also going to be pulling some insights from a fireside chat that Saylor did with Gautam Shugani from Bernstein. Now, it's super important to note that the views and ideas we're going to be exploring today are Saylor's own.
Yeah, exactly. And it's worth keeping in mind the whole presentation and discussion are really centered around an investment thesis for Bitcoin.
Right.
It's also kind of intertwined with the journey of MicroStrategy, the company that's kind of become synonymous with Bitcoin.
Yeah, the biggest public company holding Bitcoin by far.
Exactly. They've really gone all in on Bitcoin.
Yeah.
So, yeah, there's a lot to unpack there in terms of their conviction.
All right, so for everyone listening, consider this your mission. We're going to extract the absolute most vital information about Bitcoin's potential, both as an investment and in the wider world. And we're going to do it without overwhelming you with technical jargon or, making you sit through hours and hours of presentations. Sound good?
Sounds like a plan.
Okay, let's jump in. So right off the bat, Saylor introduces this idea of the investor dilemma.
Yeah, he paints a pretty interesting picture.
What's the heart of that problem?
Well, the core issue he highlights is that, the S&P 500, like most of those returns are actually driven by a very, very small group of companies.
Okay.
He calls them the Magnificent Seven.
The Magnificent Seven of the S&P 500.
Exactly. And what this means for investors is if you're just in like your typical diversified fund, you're probably missing out on those massive gains from those top performers.
Right.
And then he also talks about how alternative investments, a lot of them just aren't that easy to buy and sell, or they can't really handle a ton of investment.
Okay, so then the natural question becomes, is Bitcoin the answer to this problem?
Right. That's precisely the question he sets up. Is Bitcoin the solution to the investor's dilemma?
Okay.
And to answer that, he immediately jumps into Bitcoin's historical performance. We're talking a solid 14 years of data from 2011 to 2024.
So he's looking at it over the long term.
Yeah, and he compares its annualized returns to other major asset classes, but also to things like, monetary inflation and consumer inflation.
It's stuff we all feel every day.
Exactly.
Exactly. So what did the data show? Because I remember those numbers being pretty wild.
They were eye-opening, that's for sure. So over those 14 years, Bitcoin had an average yearly return of, get this, 168%.
Wow, 168%.
Yep. Way higher than monetary inflation, which was around 17.9% per year in that time.
Okay.
And even consumer inflation, which was about 3.6%, at least as of this recent tweet from Charlie Bolello.
Okay, right.
Although the specific rate for consumer inflation did fluctuate from year to year.
Right. So what does this mean for the average investor? Why should they care about this level of outperformance?
I mean, think about it. Holding Bitcoin during this time would have significantly boosted their returns compared to just sticking with cash.
Right.
Or even investments that barely kept up with inflation.
Yeah.
It's a huge difference.
168% versus 18% and 3.6%.
Yeah, it really highlights the potential.
Right. And it wasn't just a lucky year or two, was it? I remember the presentation really emphasized how consistent this outperformance was.
Totally. They made it super clear that Bitcoin was the #1 performing asset for 11 out of those 14 years.
Wow.
And if you look at the returns over different time frames, it's still impressive. 46% for the last 6 years, 78% for the last 8, 65% for 10 years, and even 103% if you go back 12 years. Bitcoin was consistently at the top.
Right. They even had that visual, that chart showing how all the asset classes performed from 2011 to 2024.
Yeah, that chart was really impactful.
What were your biggest takeaways from seeing it laid out like that?
I think it really drove home the point that for most of that time, Bitcoin was up there year after year.
Right.
Consistently outperforming traditional investments like gold, real estate, stocks, and bonds.
Yeah.
So the performance is there.
The data's there.
But the question is, why do advocates believe this trend's going to continue?
Right.
And what are the counter-arguments we need to consider?
Yeah, because we know there are skeptics.
Absolutely.
So the presentation then dives into the beliefs of those Bitcoin proponents and the concerns of the skeptics. Let's start with the advocates.
Okay.
What are the main tenets that, according to Saylor, these Bitcoin supporters really cling to?
Okay, so the core belief is all about Bitcoin's fundamental nature, right, and its potential.
Okay.
They see it as this digital gold, a scarce digital asset that holds its value over time, kind of like gold has historically.
Okay.
They also view it as a form of digital capital, even going as far as calling it perfect money.
Perfect money.
Yeah, because of its fixed supply and its decentralized nature.
Right.
Beyond that, they really believe Bitcoin is at the forefront of the digital transformation,
Okay.
that it offers diversification benefits for investments, and that it's the perfect capital asset for a world that's becoming increasingly digital. They use pretty strong language, talking about a financial revolution and a total shift in the economic paradigm.
Wow, that's a pretty strong endorsement. But of course, we know there's a whole camp of skeptics.
Oh yeah, they've got their concerns.
What are those main worries and objections that they're raising?
Okay, so the skeptics, they bring up some really valid points, a lot of which you've probably heard in the news and discussions. A common one is this whole too good to be true feeling, like Bitcoin's returns and potential just seems suspicious.
Right. It sounds too good to be true.
Exactly. And then there's that whole association with illegal activities, the idea that it's money for criminals.
Okay. Yeah.
And they question its real-world usefulness beyond just speculation.
Right.
Of course, the volatility of Bitcoin's price is a major concern for a lot of people.
Oh, absolutely.
And then there's the argument that it's not backed by anything tangible. It's just like digital code.
Okay.
And then there are the systemic risks, like what if governments just ban it?
Right.
Or what if some new technology comes along and makes Bitcoin obsolete?
Makes it irrelevant.
Totally. And then, of course, there's the constant threat of hacking and theft. So, yeah, the skeptics have a lot to say.
They have plenty of ammunition.
Right.
So you've got these two very different perspectives. And the presentation then talks about how people go from being skeptical to becoming believers. It even makes this bold claim that everyone is against Bitcoin before they are for it.
It's an interesting idea.
Where's that coming from?
Well, the thinking is that Bitcoin is so new, so different, that it challenges how we traditionally think about money and finance. It doesn't fit into our existing categories.
Wow.
So initially, people are dismissive, right? Skeptical. And Saylor actually uses himself as a prime example. He points to this tweet of his from way back in 2013 where he was super critical of Bitcoin.
Oh, really?
Yeah. He basically said its days were numbered and compared it to online gambling. Pretty harsh.
Wow, so he was a skeptic himself.
Oh, yeah, big time. But obviously, he's had a major change of heart since then.
So what caused that shift in thinking? What changed his mind?
Well, during the fireside chat, Saylor talked about how the turning point came around 2020. MicroStrategy, his company, they were in this tough spot.
Okay.
They had lots of cash, but limited growth potential.
Right.
And he felt like they were facing either a fast death or a slow death if they stuck with the traditional playbook.
Okay.
So he needed a new strategy, a different approach.
Right.
And that's what led him to really dig deep into Bitcoin.
Okay.
And his conclusion was it became an ethical imperative for him. He saw Bitcoin as a way to protect property rights and escape this long-term economic decline that he believes is caused by inflation. So yeah, a complete 180 from his earlier stance.
That's a pretty dramatic turnaround.
It is.
And then there's this Bitcoin journey, which the presentation breaks down into 5 stages. Can you walk us through those?
Yeah, it's like a progression. You start as a denier,
Right.
right? Basically, when you're born, you know nothing about Bitcoin.
Right.
Then, after maybe an hour of exposure, you become a skeptic. You hear about the risks and the volatility, and you're doubtful.
Okay.
Then, with maybe 10 hours of learning, you might become a trader, focusing on the short-term price swings, trying to make a quick buck.
Okay.
Then, after investing about 100 hours to understand the fundamentals, you evolve into an investor. You're in it for the long haul, seeing Bitcoin as this disruptive technology and store of value.
Okay.
And then finally, after dedicating a solid 1,000 hours to really mastering it, you reach maximalist status.
Maximalist.
You believe Bitcoin is the key to economic empowerment.
Wow.
So Saylor jokes that our deep dive today is like a 1-hour Bitcoin investor crash course.
Crash course. Right.
Fast tracking you on that journey.
Okay, so back to those early stages. You mentioned the skeptic phase.
Right.
What are some of the doubts that people are typically struggling with at that point?
Well, it often comes down to the perceived risks. It's volatile, and a lot of people just don't understand what gives it value. It seems kind of abstract and risky.
Yeah.
So the presentation stresses that to truly understand Bitcoin, you need to go back to first principles.
Back to basics.
Yeah. What
Yeah.
does that mean?
What does that mean in this context?
It means looking beyond the daily price fluctuations and the headlines, right?
Okay.
And focusing on the core fundamentals. What problem is it trying to solve?
Okay.
So that involves understanding the technology behind it, the blockchain, how it's decentralized, and also understanding its economic properties, like the fixed supply and how that's different from traditional currencies. So, for instance, instead of getting caught up in whether Bitcoin is up or down today, you should be thinking about its built-in scarcity
Right.
and how that might affect its value over the long term.
Okay. Then the presentation takes this really interesting turn.
Okay.
It starts talking about Bitcoin as the latest in a series of digital transformations of energy.
Right. It's a fascinating way to frame it.
How does he make that connection?
So the presentation lays out this timeline of major advancements in human history, right?
Okay.
All linked to our ability to harness energy. It starts with fire,
Okay, fire.
then moves to water power,
Right.
then steam, then oil, then electricity, and finally nuclear fission. For each one, he gives a little historical context and highlights a defining characteristic. Like fire, the first time we could controllably extract energy from matter,
Right.
and electricity, clean energy that we can transmit over long distances. And then, boom, he introduces Bitcoin,
Bitcoin.
invented in 2008 by, the mysterious Satoshi Nakamoto.
Right.
He calls it digital energy,
Digital energy.
energy that exists purely in the digital realm,
Okay.
programmable by computers,
Okay.
and capable of being transmitted across space and time.
So it's like the next step in that evolution of how we harness and use energy.
Exactly.
And then the argument is that the most powerful application of this digital energy is in the digital transformation of capital.
Right.
How do those two ideas connect?
Well, the idea is that capital, in all its forms, money, wealth, power, value, you can think of it as economic energy.
Okay.
And just like we've transformed physical energy to power the physical world, Bitcoin is doing the same thing for capital.
Okay.
It's taking capital, which used to be physical or financial, and turning it digital.
Turning it into this digital form.
Exactly. And that digital form, they argue, has huge advantages in terms of how you store it, how you move it around, and how long it can last.
Right. And that leads us to the discussion of Bitcoin as digital capital and a store of value. The presentation has some really massive numbers when it comes to global wealth distribution.
Oh, yeah. We're talking about huge sums of money here.
Like what kind of scale are we talking about?
They estimate that global assets are worth around $900 trillion.
900 trillion.
Yeah, that's the total estimated value of everything out there.
Wow.
And then you compare that to Bitcoin's market cap at the time, which was about 1.3 trillion.
Okay.
So at that point, Bitcoin was just a tiny fraction, about 0.1% of total global wealth.
Okay, so still relatively small.
Relatively, yeah.
And they break down those 900 trillion to different asset classes, right?
Right. They list bonds, real estate, stocks, traditional money, gold, art, collectibles like cars. They cite data from Jesse Myers at onesignaspecies.com.
Okay. And then they make a distinction between assets that are held for utility and those held to store value over the long term.
Right. So they divide that 900 trillion in half.
Okay.
About 450 trillion is in assets that you use.
Okay. Things you actively use.
Exactly, like your car or machinery for your business. And the other 450 trillion is considered long-term capital or stores of value.
Right.
These are assets people hold to preserve their wealth over time.
Right. So things like gold, real estate.
Exactly. And the argument is that Bitcoin's main role is in that latter category.
As a store of value.
Yep. They're saying its primary use case right now isn't for everyday transactions, but for holding on to wealth over the long term.
Okay, so they introduced this first law of money, L equals V over M.
Yeah, it sounds a bit technical.
What's the point of this equation?
Well, they explain it as lifespan equals value divided by maintenance cost.
Okay.
And the idea is an asset's effectiveness as a long-term store of value, it depends on how well it retains its value over time.
No.
And how much it costs to maintain it. So the lower the maintenance cost for a given value, the longer its effective lifespan.
The longer it lasts.
Right. And they use this framework to analyze how traditional assets, both financial and physical, tend to degrade over time.
To lose value.
Exactly. And, this framework is interesting, but how might, say, other economists view this first law of money? Would they agree with it? Well, some might argue that it's too simplistic, that it doesn't fully capture all the factors that influence an asset's value and how long it lasts. Things like market demand, technological shifts, even geopolitical events.
Yeah. It's a complex world out there.
It is. But let's see how the presentation applies this law to financial assets first.
Okay, so financial assets, what's the argument for how they lose value over time?
They argue that financial assets like government currencies, the Argentine peso, the Turkish lira, even the US dollar,
Okay.
stocks, bonds, mutual funds, they all lose purchasing power over time.
Uh,
And that's because of things like inflation.
right. Prices going up.
Yep. And also government regulations, political instability, those can erode value too.
Okay.
They list a bunch of financial risk factors, taxes, competition, the risk of a business becoming obsolete, even bad management.
All things that can impact those assets.
Exactly. And they give approximate useful life ranges.
Good.
Like a volatile currency, like the Argentine peso, they say maybe 2 years.
2 years.
But a highly diversified fund, maybe it lasts 100 years.
Okay, so a pretty big range there.
Yeah. But the point is, even the longest ones, they have limits when it comes to truly long-term wealth preservation.
Right.
Okay, so then let's shift to physical assets.
Physical assets, so things like a fancy car, a piece of land. How do those hold up under this first law of money?
Okay, so for physical assets, think like a Ferrari, a yacht, but also things like a house, silver, a warehouse, gold, a painting, even land.
Right.
They argue that these are all subject to degradation.
They break down.
Yeah, wear and tear, decay, entropy.
Right.
And then, again, political instability and economic turmoil, those play a role.
Those can definitely impact physical assets.
For sure. They list physical risk factors like property taxes,
Yeah.
the risk of economic and political chaos, crime, natural disasters, and increased competition in the market.
So even those tangible assets aren't completely safe.
Nope. And again, they assign estimated useful life ranges. A high-performance car, maybe 5 years. Land, maybe 91 years.
Okay, so again, there's a limit, even with physical assets.
Right. They're highlighting that even tangible things face limitations in holding their value indefinitely.
Right, without ongoing costs and risks.
Exactly.
So this is where they bring in Satoshi Nakamoto and what he did with Bitcoin. What was so revolutionary in the context of this discussion about lifespan and risk?
Okay, so they point out that, yeah, we know Bitcoin can transfer value digitally without a bank. That's cool.
Right.
But the truly groundbreaking thing, they argue, is that Satoshi figured out how to store value without needing a trusted third party.
Okay.
No bank, no institution. And that eliminates a whole bunch of risks. The risks that come with banks and financial institutions.
Right.
And a lot of the physical risks and maintenance costs that are tied to tangible assets. Bitcoin exists purely digitally.
It's all in the digital realm.
Right. So they argue that it bypasses many of those traditional risks that degrade the lifespan of other assets.
Okay, so it's like it's built to last longer.
Exactly. And that's where they get to this claim about a revolutionary lifespan for Bitcoin as an asset.
Okay, how long are we talking?
They're suggesting it could last 1,000 years or more.
1,000 years or more.
Yeah, which is crazy compared to the estimated lifespans of those other financial and physical assets we talked about.
Right. It's orders of magnitude longer.
Right. And that potential for extreme longevity, combined with relatively low maintenance costs, like the electricity to run the network, that's presented as a key advantage for people who want to preserve their wealth across generations.
Okay, that's a pretty compelling argument. The presentation then digs into some specific advantages of Bitcoin as this digital capital, comparing it to something like a building.
Yeah, they really lay out the benefits.
What are some of the key ones they highlight?
Well, when you compare Bitcoin to a physical asset like a big commercial building, the advantages are pretty clear. No property taxes, no worries about vacancies, no tenants to manage, no legal liabilities tied to the physical property.
Okay.
You don't have to deal with local regulations or worry about the building getting old and falling apart. And beyond just avoiding those burdens, Bitcoin has all these other desirable attributes.
Okay.
It's practically invisible, so it's harder to steal. It's indestructible in the digital world.
Right.
It could potentially exist forever. You can transfer it instantly anywhere in the world.
Right.
It's programmable, so you can use it for all sorts of financial applications. It's divisible into tiny units.
Okay.
It's fungible, meaning one Bitcoin is the same as any other Bitcoin. It's configurable for different purposes.
Right.
And, they even call it musical in the sense that its value can potentially appreciate significantly over time.
Okay, that's quite a list of benefits.
It is.
All right, let's talk about the elephant in the room, the thing everyone thinks about when they hear Bitcoin, volatility. The presentation addresses this head on, and it argues that it's a feature, not a bug. What's the logic behind that?
Okay, so the argument is that Bitcoin's price volatility, it's directly tied to its fundamental characteristics.
Okay.
It's traded globally, 247, in this totally open and competitive market with very few restrictions. Okay. So anyone can buy or sell at any time, anywhere in the world. There are over 1,400 crypto exchanges that facilitate this constant price discovery.
Okay.
And there's no central bank stepping in to stabilize things. So yeah, you get those big price swings.
Right. It's the Wild West of finance.
Yeah.
But how does that volatility become a positive thing? They call it a feature. What are the supposed benefits?
They argue that this volatility is what attracts the best capital, the most interest, the top talent, and the cutting-edge technology to the Bitcoin space.
Okay.
For long-term investors, the volatility is the price you pay for potentially huge returns.
Right.
For traders, it creates tons of opportunities to profit from those short-term price movements. For innovators, it opens up all these possibilities for creating new financial products and services built on Bitcoin. And for corporations, it can offer them greater access to capital, although they have to manage those price risks carefully.
Right. So it's like a double-edged sword.
Exactly.
They also claim that Bitcoin is uncorrelated with the S&P 500.
Right.
And that it offers higher risk-adjusted returns.
Yep, that's a big deal for diversification.
Absolutely. So what's their argument there?
They're saying that the things that drive Bitcoin's price, they're largely independent from the factors that affect the stock market.
Okay.
So things like economic indicators, corporate earnings, traditional investor sentiment, they don't really move Bitcoin in the same way.
Okay.
So Bitcoin can act as a hedge, a way to diversify your portfolio. And even though it's volatile, they argue that the returns have been so high that it actually has a better risk-adjusted return profile than the S&P 500.
Okay.
And there's another point they make. Bitcoin doesn't have the traditional counterparty risk. You're not relying on a bank to stay solvent or to act in your best interest.
Right. You're not depending on a third party.
Exactly.
Okay. And the performance data they showed for the 4 years leading up to October 2024 definitely supports that idea of strong returns.
Right.
What were those numbers again?
So for the 4 years ending October 8th, 2024, Bitcoin had an average annual return of 49%.
49%.
Which is massive compared to the Magnificent Seven stocks, which returned 27%.
Okay.
The S&P 500 was at 14%, real estate at 10%, gold at 7%, and bonds actually had a negative return, negative 5%.
Okay.
They got that data from FactSet, and it really highlights how well Bitcoin has performed recently compared to other major asset classes.
Right. It really stands out. And they also touch on Bitcoin's dominance within the broader crypto market.
Right. They point out that most other cryptocurrencies have been losing value compared to Bitcoin.
Okay.
Bitcoin's market dominance, also known as BTCD, went up from 50% to 58% in that year.
Okay.
While Ethereum, the second largest crypto, dropped 36% against Bitcoin. So it seems like there's this flight to quality happening in the crypto market, with Bitcoin becoming the safe haven asset.
Right. The king of the crypto hill.
Exactly.
Okay. So let's address the fundamental question. What backs Bitcoin? What gives it value? The presentation offers a pretty interesting perspective on this.
Yeah, they say Bitcoin is backed by power, by the computational power of its decentralized network.
Okay.
They cite figures like 700 exahash, which is a measure of how much computing power is securing the network.
Right. All those computers crunching numbers.
Yeah, it's a massive global network, and they say it consumes over 18 gigawatts of energy.
18 gigawatts.
Which, to put that in perspective, is more than major tech companies and even the entire U.S. Navy.
Wow, that's a lot of energy.
It is, and that's just one factor they point to as supporting Bitcoin's value. They also highlight the financial investment that's already gone into the Bitcoin network. Over $800 billion in total market capitalization.
Right.
And of course, they talk about MicroStrategy's own investments.
Right, they put a lot of skin in the game.
Oh, yeah. $9.9 billion since August 2020.
Okay.
Their initial investment was $250 million, and they've just kept buying. So they're putting their money where their mouth is.
Right. They're not just talking the talk.
Exactly. And then there's the network effect. They estimate there are 420 million people worldwide who are, pro-crypto, and 200 million who actually hold Bitcoin.
Okay, so that network's growing.
It is. And that's another factor they believe supports Bitcoin's value.
Okay, so the presentation then shifts gears to talk about how Bitcoin has evolved into a recognized asset class and how institutions are increasingly adopting it.
Right.
They outline a few key stages in this evolution.
Yeah, they describe it as going through these distinct phases.
Okay.
The early days, from 2008 to 2012, those were the idealists, entrepreneurs, and crypto cowboys.
Okay, the Wild West days.
Right. Then, from 2012 to 2016, you have the crazy years, lots of volatility, lots of experimentation. And then starting around 2016, we enter the phase of institutional, corporations, and investors.
So the big players are starting to get involved.
Exactly. And that's where we are now.
Okay. And they use a timeline to mark this progression, highlighting some key milestones. Let's go through a few of those.
Okay, so the timeline kicks off with Satoshi's white paper in October 2008.
Okay, the birth of Bitcoin.
Right. And back then, it was basically worthless.
Right.
Then you have Pizza Day in May 2010, where someone famously bought pizzas with Bitcoin.
That was the first real-world transaction.
Yeah, for like $0.004 a coin.
Wow.
Then in April 2011, Satoshi disappears from public view. At that point, Bitcoin was around $1.50.
Okay.
Fast forward to March 2014, the IRS officially designates Bitcoin as property for tax purposes.
Okay.
It was valued at about $580 then.
So the U.S. government was starting to take notice.
Right. And then we get to the block size wars from 2015 to 2017, which was this big debate about how to scale the Bitcoin network.
Right.
Prices were swinging between $900 and $2,700 during that time.
Right.
August 2017, Bitcoin Cash forks off from Bitcoin.
Okay.
The price was $2,727 then.
Okay.
September 2017, the first Bitcoin mining company goes public, Hive Blockchain.
Okay.
Bitcoin was at $3,400.
Okay.
October 2018, Fidelity launches Fidelity Digital Assets.
Right. A platform for institutions to hold and trade crypto.
Yeah, Bitcoin was at $6,565 then. March 2020, COVID hits. We get negative interest rates. Bitcoin was around $6,575. August 2020, MicroStrategy, Square, Tesla, Coinbase, all these big names jump into Bitcoin.
Okay.
The price was around $11,400 then.
Wow, it was really starting to climb.
Yeah. Then throughout 2021 and 2022,